So this will be the review and kind of the final exam prep for the final. Again, you'll take the final on Blackboard. Before you start the final, make sure you turn in the homework, um, have the term project turned in, and the rest of that. Anyway, I'm going to go through some of the questions on the exam because the exam is kind of a good review of the course anyway, to kind of highlight some of the high points, some of the key takeaways from the course. So it's going to be multiple choice, just like the others. 72 questions, so quite a few. You know, it's not open book. If you tried to do open book, you run out of time. You'll have 90 minutes to get it done, and 72 questions. So, you know, just answer to the best of your ability. Watch this, video though, and you should be in pretty good shape. But in terms of being able to look things up and stuff, yeah, that time would not allow for that, and the exam will just close out on you. If there are problems with the exam itself, in terms of your computer, somebody's laptop always dies or lose a connection or whatever, you can get a hold of me. We can try and get that reset if it's justified. Alrighty. So when we're talking about insurance, the person who benefits, who's named, is the beneficiary. So the key thing with any sort of, well, we're not quite in a state. We're more, well, we are, yeah, because we're talking about life insurance in this case. You need to, take some care in choosing that beneficiary, but also you need to let them know. You're not going to be around to point out where the will was kept. There's certain documents that are stored online, all the, mortgage documents, property documents, things like that, unless they're in, foreign country or something. But most standard stuff is fairly easy to recover. But a copy of the will, and maybe it's just the lawyers I deal with, but they don't retain a copy. They give it to you, and that's all on you. So, you can obviously make copies of it, store someplace properly, but definitely inform the beneficiary of, and ideally just give them a copy so that, it's one less thing to worry about. Another thing we talked about, well, this is kind of, we're going to be skipping around a bit. Here we're talking about a bond that can be exchanged for shares. So remember, a bond, when a corporation or even an entity, because municipal government, federal government, other folks can issue bonds. Bonds are just a loan instrument, and there's kind of a fallacy that banks, at least the big banks, they make big, huge loans. They don't typically have that kind of capital, those kind of assets. They usually are the intermediary. If a corporation needs to borrow a whole bunch of money, they'll go to a big bank who's going to help them out, a big commercial bank who's going to organize either a stock sale or a bond. But anyway, what we're talking about in this case is if you have a bond, which is just a debt instrument, it's just a loan. You don't own any part of the company. But sometimes those things can go back and forth where they can be converted into stock. And stock is an equity position. And that ability to go back and forth is called being convertible. So a convertible bond, if somebody says a convertible bond, that's what they're talking about. A bond that under some conditions can be converted into an equity position. Again, do what you want with bonds. I don't think they're as useful as some people do. Some people make a lot of money on bonds, but that's by trading them. Those are the big boys, trading stuff back and forth. But in terms of actual retail investors and things like that, doing bonds, that's not the economy we have right now. If you haven't seen, most people are getting clobbered who aren't holding assets or doing things like that. And if you're holding bonds, getting some trivial interest rate, probably not going to work. We'll see. I mean, things change. They've changed a bit already. Call feature on a bond. So let's say you get a bond and it's giving you a great interest rate, and actually too great an interest rate, because the issuer of the bond, if they have a call feature in it, they may call that bond. They may say, hey, we're paying you 8%, but basically we don't need to do that anymore because the prevailing rate is down, 4 or 5%. And so rather than honor the conditions of the bond, well, it is one of the conditions of the bond that there was a call feature, and they'll just say, yeah, we're not paying you 8% interest anymore. Here's your money back, and the bond's been called. When you're getting insurance policy or basically any contract, if there's like an addition to it, they can either number of terms, but a rider, an addendum, in the codicil. But anyway, in this case, if we're talking about a property insurance policy, and you've got a bunch of one particular item, like a bunch of guns or photography equipment or classic cars or something like that, and you think it's covered, you may be disappointed. This does come up, again with classic cars, for example. Let's say you've got, a 63 Corvette, and this is kind of an extreme example because most of the time when you register a 60 or go to insure a 63 Corvette, they're going to realize there's some classic value to it. But if you just went with your, generic insurance company and you register this 63 Corvette that's worth, I don't know, 60 grand or so, and you go to file a claim because it gets destroyed in a fire, and they're like, yeah, that's a 70-year-old car. Here's $600 or something. So you need to make sure, especially when you've got something of value, because of its conditions, because of its collectability, that it's appraised and insured for what it's worth. And don't think you're pulling one over on the insurance company. They've been doing this a lot longer than you have, and they're generally not going to come out on the short end of the deal. So, again, make sure that your stuff is appraised for its actual value, and that's noted in the policy. Mutual fund that has no sales charge is a no-load fund. So this is the way it works. Again, things have changed. Back in the day, there were salesmen that presented, and there still are some. And if you're, gullible, I hate to say it, but yeah, if you're paying a load on a policy, which is essentially a commission, you're not allowing your money to work how it should. You have the time value of money, and if they take a commission on the front end, meaning on your initial investment, that is going to penalize you big time on the back end. So anyway, there's no need to pay a loaded fund. You can buy your own lunch. You can buy your own, it's like timeshare incentives where they take you out to lunch or whatever. You need to be very skeptical of deals like that, because if they're trying that hard to sell it to you, there's likely a problem. Mutual funds. So a great alternative for investing to get exposure in the stock market with trying to mitigate the risk and also eliminate or reduce the amount of time that you have to spend actually studying the investment is a mutual fund. What you do in a mutual fund, there's all types of mutual funds, but a typical mutual fund, probably one that you'd be interested in. There's a fund manager who selects, stocks based upon certain criteria that's laid out in the prospectus, kind of the rules of the road. And in this case, they're saying we want to invest in stocks that are engaged in growth, and we're going to go with this certain selection, and we're not going to necessarily put all our eggs in one basket. We're not going to invest in one particular company. We're going to invest in companies, a range of companies that have the potential for growth. And in doing that, that fund manager has kind of taken the burden from you in terms of selecting the stocks, and they've also taken the position in terms of, just managing positions and making the transactions very easy for you, and just it's just a little less stressful unless you know have a desire to trade stocks yourself. But anyway, if they get involved in common stocks that are rapidly growing corporations with a higher than average revenue, yeah, that sounds like growth stocks, which is correct. There's other types of funds. There'd be like a balanced fund, which might have some bonds, might have some big blue chip, you know, established companies in there. There might be other ones that have specific sectors or industries. There might be other ones that are paid dividends. Those would be classified as income funds. But if you're looking for growth stocks are trying to grow, so they're not paying a dividend because they're buying buildings. They're not, you know, they're getting the profits from the company and they're rolling that back into the company. They're not a big mature company that's paying a dividend that is now turning profits back over to the shareholder. No, you're trying to make your money on the share appreciation. There's two primary ways to make money in the stock market when you're, you know, buying individual stocks. And one was by the share price going up, and the other is with the dividend. And anyway, in this case, we're looking at growth stocks. All righty. Now, mutual funds that pick like a specific sector, and there can be some overlap. You know, if I say you're going to be getting into growth stocks, that might very well line up with technology in this day and age, or, you know, specifically AI. But if a sector fund could also be medical, could be defense, could be, you know, energy, all kinds of stuff. Right now, I've gotten my butt kicked every time I've tried, but right now, medical stocks are just kicking butt right now. I think they're gonna do some good things in the field of cancer, which is great. And so this kind of, I mean, it's not all unethical greed, capitalism. This, you know, by investors rallying to the medical sector to, you know, at the base of it, try and make some money off of a potential cure for cancer. There's multiple benefits there, and without the stock market and capitalists to provide all that money, there's a reason why this innovation takes place in the States and to a lesser extent other places. So anyway, you can feel good about it and perhaps make some money. Not me, though. I've gotten burned way too many times in the medical sector. Mutual funds, we're beating this one to death. This is just more of a general definition, you know, about pooling the money of many investors and shareholders to invest in a variety of securities. So that sounds like diversification, because it is. That's a good thing. You know, the fact that you don't have all in one stock. Now, sometimes it's great to be focused, you know. I was lucky. I bought NVIDIA. I could have invested across the whole tech sector, but I bought a single company and ended up being kind of the leader of the pack. Sometimes you get lucky, but I also could have chose, you know, Intel or AMD or something else and maybe not done as well. So anyway, the easier, the more prudent way to do it is to invest in a mutual fund and you know, be a little less myopic when you're looking at it. Again, jumping back into insurance type things. Let's say you have some child, in fact, I think it just happened again, where some teenagers got into an Airbnb, destroyed the place. They did $250,000 worth of damage in somebody's Airbnb with some party. Anyway, you know, yeah, harmless kids. What? Actually, if they track down the kids, and then the kids probably don't have much money, but there's a concept that you as a parent would be aware of. It's called vicarious liability, meaning, yeah, that was your little child that did that. You should have taken responsibility for the child. you're on the hook for the damages. So that's a fairly extreme case, but you know, but if your child does get into trouble, or somebody else, um, under your care gets into trouble, and you were negligent, yeah, you're done. You can go to court, and they can cite vicarious liability, meaning that you're responsible because you were responsible for the person who took up the action. You're done. In stock trading, different ways to buy stocks, different orders to put in. Most of the time, I just use market orders because, whatever, I may be better at long-term planning. Short-term, I'm like, it's going to go up, it's going to go down, and I usually, anyway, when in doubt, zoom out. In the big picture, I do better, but in the small run day trading, as are most people, it's fairly hopeless because it's really hard to guess short-term stuff. Anyway, so I tend to do market orders. But if I had a conviction that it's going to go one way or another, I might do some form of a limit order. Okay? And so a limit order would be, I want to sell this stock. It's trading at, $67 right now. If it gets to 68, I want to set a limit order that's going to sell that stock at 68. Conversely, if I want to buy and it's traded at 67 right now, I can set a limit order to buy when it descends to 66. If it doesn't descend to 66, then nothing happens. My order never gets placed. If it does descend to 66, all of a sudden my order is converted into a market order, and the trade goes forward. Does it mean that I'm going to actually buy that stock at 66 even? Nope. It means that I now have a market order and the next trade. And if it's a high volume stock, it will probably be right at 66 or very close. But for example, if you try to enter in a limit order after hours, after regular Wall Street hours, they'll typically preclude you from doing that because they'll say, yeah, there's no volume. We don't know what's happened. Overnight, the market may open way up, way down. This is not a good idea. And generally, they won't let you do it. It's kind of the nanny state in that one. Again, what we're going to see over the next couple of years is going to be interesting. I think all these artificial limits in terms of stock market opening and closing are going to go away. Bitcoin and crypto are 24/7. They trade all the time. In fact, on Sundays, I see a lot of volume late in the afternoon on our afternoon on Sunday because the Asian markets are opening up, and they'll generally start trading quite early. So I think you're going to see stock markets also go to a 24/7 model, but that will be a different thing. Okay, kind of get-rich-quick schemes in terms of stocks, penny stocks. So stocks that trade for less than $1 are penny stocks. And the reason why there's so many penny stocks, granted, there are some companies, most companies, when you're going to do an IPO, initial public offering, you don't typically, good companies don't enter in as penny stocks. They, will set some share price, maybe in the $30, $40 range, and they'll start trading at that. If a stock ends up down in the penny range, they're probably on the way out the door. That company is probably failing. Now, there can be companies that can start down in the penny stock range and trying to hype things up. But the problem with the penny stock range is that a lot of the securities exchange rules do not apply. And so they can do some pretty shady things down in those levels that would not be permitted. if a company comes out and makes a statement, if you're say you're, chairman of a corporation or have an official position in a corporation, and you come out and make some comments like, say, Elon Musk or something that might affect the stock price, it's quite serious. You can go to jail if you're found to be trying to manipulate the stock price. Things are fairly well regulated in the legitimate market. Penny stocks, those rules don't apply, and so you need to be very careful. And if you are trying to do some get-rich-quick scheme in the penny stocks, no, probably going to end up in the middle of a pump and dump. Probably going to lose what you got, and for the most part, don't do it. I've not recently, but hell, 20 years ago I did it, and I don't think I've ever came out making any money on penny stock. It was fun to watch. I mean, they jumped all around, but yeah, you're typically getting played. Let me see. Let's say we're getting into auto insurance now, and we're talking about somebody who, say, people who have like a DUI or something like that, or just are, reckless drivers. If the state hasn't taken away their license and they still allow them to drive, there's a bit of a problem. No insurance company wants to insure them, but yet the state, has a law that they must have insurance to drive. So the way they kind of remedy this situation is they make not a deal, but they force insurance companies who are going to do business in the state to take part of this, what they call an assigned risk pool, some of these bad drivers, and they don't necessarily tell the insurance companies how much they can charge. They can give them exorbitantly high premiums, but they can get these people insurance. So in automobile insurance, because there's a mandatory requirement for liability insurance, but so you have some of these drivers who require insurance, they'll make that conditional for the company to take one of these guys. I guess it'd be like the SR22 program here in Alaska, where you've got drivers that clearly got some issues, but they still need insurance. And who insures them? The companies that are already up here providing insurance to other people, they're forced to provide insurance to those people as well. We talked about a will. A will only means one thing. That's that legal declaration of a person's mind as to the disposition of his property. So all these other things, if you're doing a will and you just wrote it up yourself, nah, that's not a will. That wasn't, prepared in accordance with the state because it wasn't signed by witnesses. It doesn't conform. So you're wasting your time. A personal letter, any of that stuff, verbal statements, doesn't matter. If you do any of those things short of a will, you're going to end up in probate court, and, well, not you, your estate, and it's just going to be divvied up per the state. So it does happen. Here's a lady. She's bought and sold some shares. You're going to have to just do a math problem on that. She buys it for one price, sells it for a higher price, hopefully. And then if she paid a commission, silly her. But anyway, that has to be subtracted from the profits. And if she got any dividends, that has to be subtracted as well. Again, most people are not paying commissions on stock trades anymore. Stock, brokerages have found other ways to extract money from you. They don't necessarily need to do it through that. Okay, here's this guy. He's thinking about investing in, high-risk stock. He's going to get rich quick, maybe down in the penny stocks or whatever. Well, he's not investing in treasury bills. Those are government securities backed by the full faith and credit of the government. He's not doing CDs because those are, again, just very stable debt instruments, usually backed by government securities. Low growth stock, no. And why you would seek out a low growth stock, I mean, you might look for a stock that pays a dividend, but to specifically seek out a low growth stock is kind of strange. But low risk bond, no, bond is a debt instrument, different thing again. But a speculative stock. So again, it's multiple choice here. The speculative stock, speculation is different than investing. You know, it's fun to speculate, to try and guess and forecast and stuff, but you should not have the bulk of your wealth in that. If you want to allocate, let's say, 10 or 15% to your retirement savings, and you're doing well and you're disciplined and that nest egg is being built, and then you have some extra money, and it coincides with, you know, your buddy or the internet or somebody offering you a stock tip on some, you know, under the radar stock. Well, yeah, maybe you want to do that, but it's kind of like going to Las Vegas, although slightly better. I mean, somebody's going to build the casinos in Las Vegas, so at least in the stock market, there is a chance that you can win. But yeah, that's not a disciplined investing approach. Make sure you've got your bases covered with prudent investment before you start speculating. All righty. Here's a lady. She's going to the doctor. Has to pay a little something before. So, you know, this could be a doctor's visit, car insurance type thing. Anytime you have to put up some money in an insurance situation before they start paying, that's called a deductible. So if you've got a $200 deductible, $500 deductible, and there's, say, $1,800 worth of damage, and you've got a $300 deductible, you're going to get a check for $1,500, and the other $300 was on you. So the way things are supposed to work with some of the securities, and gold definitely falls in this category. Bitcoin is supposed to fall in this category, hasn't quite done it yet, but easing of international tensions is said to cause gold prices to decline, right? Gold is supposed to rally. Precious metals like that, very safe. There'll be a flight to safety. You know, investors will if they get spooked in the market, they think things are very turbulent, it should cause gold prices to go up. Conversely, if everything's, you know, all the world wars are going away and all the other stuff, it should cause gold prices to go down. We'll have to see. Right now, things are not quite working out that way, but that is the logic, and that's the academic answer at this point. So easing of tensions should cause prices to go down. Heightened anxiety should cause prices to go up in the gold market. You know, something that's a safe asset like that. Talked about estate planning. Yeah. So estate planning has to do with what's going to happen after you die. Now, obviously, if you wait till you die to accomplish, you can't. Or have somebody else plan it if it's too late. So you got to plan for this stuff while you're alive. And, you know, so it takes care of the security of those who are going to be left behind. What's going to happen to your assets. Leverage. When we talk about the term leverage in personal finance or finance in general, that means using borrowed money. There's a whole bunch of people who got wrecked just a few weeks back in the crypto market because they used borrowed money to buy crypto. You know, do not do that. In fact, using borrowed money to buy stocks even is, I've never done it. And, well, not knowingly, one time I did by hitting the wrong block, but not a huge amount of leverage. But some people will use insane amounts of leverage, you know, 4x, 5x leverage, 5 times, meaning that they have to keep, anyway, it gets more complex. But using borrowed money for investing is called leverage. Now, in the real estate world, that's quite typical. But for volatile assets, not good, because you can get knocked out of the market, margin calls, and you're done. Regarding retirements, yeah, the main thing is that you need to start saving as soon as you can, because of that time value of money. Things kind of sneak up on you. People have, some misconceptions that oh, once I'm retired, Medicaid will take care of all my medical bills. No, not necessarily. Pension plans from employer, no, you can't necessarily count on those anymore. They typically don't even exist, or if they do exist, it's tied to the health of the company, which may or may not be there. Trying to calculate how long you're going to live in retirement is difficult also. So anyway, the true answer is saving whatever you can to help your retirement. And then also, if you're smart, finding a way to access that money for other investments, not spending it, but using it as collateral or other things while you're still in your working years. Here's a lady with a bunch of expensive photography equipment. What does she need? A personal property floater, right? That camera equipment needs to be delineated in the policy so that she can be sure that it's covered. Here's one with this guy died without a will. What do we call that? Intestate, right? Meaning it's going to be a mess. The beneficiaries may or may not ever get the money. If they do, it's going to be a long time coming, and it's not going to be very much money because, the state hired attorney or however that worked is going to take their cut, and just not a good situation. Here's a guy with the will. He's got everything squared away. It's going to go to the legal process. What court is that going to go to? It's going to be a state court. It's going to be the state probate court. So, again, if you move from state to state, if you move from, Alaska to Arkansas, well, you no longer have a will. If you're going to be a resident of Arkansas, you need to figure out, get a new will for that state if you're going to be a permanent resident. Sometimes there's some mutual funds. You can find them. They vary in popularity, but they're called life cycle funds. And there's a notion, and then it's a strategy, more precisely, that you would be in growth stocks and other things when you're young, and then as you get older, you should be in more conservative stocks, and then towards the end you should be in stocks that are actually paying a dividend, and then at the end you should maybe be in just government securities because you don't want any volatility at all. I don't necessarily subscribe to it, but there are products out there that provide that sort of cycling, and they're called life cycle funds. And so you'll see whatever it'll say, life cycle 2050, meaning that this fund is targeted for you to retire in 2050, and this is the strategy they're going to take. But anyway, the products are out there. If we talked about the value of bonds in relation to interest rates, so when you get a bond, there's a bond that's, say, paying 4%. That 4% is going to remain constant throughout the life of that bond. Now, if the interest rates go up or down, it's going to affect the value of that bond in the secondary market. So let's say it's a $20,000 bond, and if the interest rates go up, the new interest rates, meaning you can go get a bond right now that'll pay 5%, your existing bond at 4% isn't as desirable. So if you went to sell that bond today, you might only get $18,000 for it. Conversely, if interest rates drop to, say, 2%,
and you've got a bond that's paying 4%, you might be able to get, 22, 25,000 for that bond. So that's how that works. Yep. Increase, it works both ways. Yeah, if you die without a will, again, a lot of stuff on wills here. But anyway, there is a state provision out there that says, basically your assets with the lack of a will, if you die intestate, next of kin and whatever order of succession will be the default unless you specify otherwise. That's not to say that's a good idea, because you have to go to probate court to get the judge to recognize that, and it's a needless process that could have been eliminated by you making it more clear. Illiquidity. So the ability to turn something into cash deals with liquidity. So stocks are fairly liquid. You can turn those into cash within a couple days. Cash is the definition of liquidity. It's ultimate liquid. Real estate is illiquid. Real estate probably going to take you at least 6 weeks or so to get the money out of that. So, why do you purchase life insurance, and what the amount should be? There's one person who's, if one person is, say, the breadwinner, anyway, that's the term they use, the person who's bringing in the money, the life insurance is supposed to make up that vacuum caused by that person exiting. So if you're a single college student or a single just living on your own, the need for a will, the need for life insurance, well, you should probably still have a will, but the life insurance is not necessary if you don't have people who are dependent upon you. Another stock problem: buying, selling. You set the price. Here's a person looking at stock selecting. They're looking for something to earn above average profits compared to other firms. Yeah, so their choices were defensive stocks, cyclical stocks, small cap, blue chip, or a growth stock. So the growth is the one that has a potential to earn more. Now again, it's an appraisal of that stock. A defensive stock sounds like something like a big established stock that might be a hedge if you think things are going wrong. Cyclical, certain things like petroleum and banks and other things tend to be cyclical. Small cap, that just refers, typically that is a growth stock, but not always. It just means it's a smaller company. Blue chip means one of these big established companies. Not expecting a lot of growth with that. You are expecting probably a dividend. This guy bought a car and he's looking for certain safety features. He's trying to do risk reduction, right? You can't avoid risk. If you're going to drive, you're going to be exposed to some risk. You can do some amount of risk assumption by having the insurance company assume that risk. But in this case, in terms of buying safety type things, you're trying to reduce the risk, which is a valid strategy. How do they do life insurance tables? They basically have all sorts of data. The more data they have on you, the more happy they are. But yeah, they use things called mortality tables that will tell, you're a male of this age, with this disease history, and they calculate kind of when you're expected to pass. And they assess your premiums. If they think you're good for many more years, they'll issue the policy at a reasonable rate. If it shows that you're, have a propensity to die the next couple of years, you maybe find that you're uninsurable. Here's a guy just graduated from college. Not a whole lot single, the other things. Probably somebody who should, again, get involved in growth stocks as opposed to bonds, government bonds, commodities. Commodities are, that's a whole different category that gets into speculation. Money market, way too cautious. You need something that's going to outpace inflation, that's going to build you a nest egg, and that's going to be growth stocks. Health insurance policies. The one good thing that we have with health insurance is that most employers have group policies that you can buy into. So in terms of, the Affordable Care Act, the ACA, Obamacare, whatever you want to call it, that's not a huge program. That, insures, I believe, about 8% of the people. Not big numbers. Most people still get their insurance through their employer, at least working age people. Which one of these stocks is or which one of these investments is going to get you about 10% return? 10% is pretty good, right? It's not going to be T-bills. It's not going to be corporate bonds. Options you could get a whole lot less, a whole lot more, or you could just whatever. And the one that's going to get you about 10% from, it's proven since the turn of the century, broadly is in the stock market, in equities. So one way or another, you're probably going to find yourself invested in the stock market. If you're buying a mutual fund and you want to see how things are going to run in terms of what the fund manager's rules are and what type of investments he's going to be looking at, the document you're looking for is called the prospectus. There's a legal requirement for you to, at least not acknowledge reading the prospectus before you invest. So that's that. Here you're just say you're going to invest in very conservative investments and you're going to avoid all risk. No, you're not. Because inflation is kind of that insidious force. That's inflation risk occurs when investment does not keep up with the prices that are increasing the overall economy. So it's kind of a fallacy to think that, I made 2% interest or something and I'm doing well. No, you're drowning. The buying power of your money is going down. Even though it may be going up slightly each year, it's not worth as much. We talked about an annuity. Annuity it's used in the insurance scheme, and it's kind of the reverse of a life insurance policy. Annuity pays you a fixed amount each month for in most cases the rest of your natural life. So like life insurance, you have to die to get it, get the payment. In an annuity, you have to keep living to continue with the payment. So in that way, it's the opposite of insurance. Okay, here's she's got some stock. Maybe you have some stock in a company, and if you've got 10 shares, 100 shares of a company, don't expect an invite to the shareholder, convention. No, what you're going to get instead is you're going to get a document called the proxy. And a proxy is a document for you to assign your shares, your votes, to another person for them to vote on, on the issues for you. So it's just a formality, not a big deal. I generally just avoid them or ignore them, put it in the junk mail category. But anyway, they have a legal requirement since you're a shareholder, since you've got a position within that company where they're going to send you these letters and get you to vote. Here's a guy, he's making $3,000 a month, and he's setting aside all his bills, his groceries, his rent, and also his investments at the first part of the month or whenever you get paid. But treats investments as if they were a bill and makes them part of the budget. That concept is called paying yourself first. And that's what you want to do. Very disciplined. You'll, once you get used to it, it forces you to live within your means, and that's how you're going to do it. Again, getting back to the big picture, if you're not holding assets are going up in money, and I know it's hard to get there from here if you have nothing, but the divergence, the K-shaped economy, everything we've got going on, the asset holders are doing quite well, and if you can't beat them, join them. You need to try to get into the asset holding class rather than being kind of a slave to them with the whole, you'll own nothing and be happy mentality. Okay. Here she's 10% to the 401k. And because of that, doing it at work, and there's a match program. So, yeah, if there is a match program, you need to take advantage of it, right? And with a 401k, it's similar to an IRA, a 403b, all these different tax-deferred programs. Programs that mean that you get your retirement money and you take it from your income before paying taxes on it. It goes directly to investing, and it's tax-deferred. So when you go to retire, when you're above age 59 and a half, you withdraw that money. You can pay the taxes on it then. Back to insurance type situations, negligence. Negligence is failure to take ordinary and reasonable care. So this is a situation where, you happen to leave a bunch of stuff out in the snow. It's now, there's a ladder or a rake out there, and the guy comes over to check the meter or do something around your house and trips on this thing and hurts himself badly and, sues you, and it happened on your property, and you were careless in leaving all these things around that were, the jury decides was not ordinary or reasonable care on your part. Yeah, you're found negligent and you're hurt. So don't be negligent. It will greatly affect liability type issues later on. Here's an advantage. So if you're involved in an investment and you're a limited partner, you don't have to be a lawyer, but you do need to know just a little bit of knowledge on that. And a limited partner, if you're limited for some reason, it is for a reason, to minimize your liability. So like I said before, if you invest, say, $5,000 and you're a limited partner, if that investment goes completely south, you're out your $5,000. If you're a full partner or just a partner in that thing, and the company loses, $20,000, but you only have $5,000 invested, you're still on the hook for these other losses. So a limited liability type thing is if you're in that condition, make sure you stay that way. Long time ago, I delivered pizzas for a company. It was run by some limited partners. They were dentists, and it was the best place to work ever, because we had all these cars that were provided by the company, and we were just completely irresponsible. But only the manager could reach out and tell us what to do. The limited partners, the dentists who ran the place, they couldn't say, "Hey, you guys all need to be fired. You're friggin' irresponsible." Anyway, unique situation, but due to their limited partner situation, they could not be involved in day-to-day management, so the situation continued. That'd be a whole different story and a whole different lecture, but anyway. Perils. When we're talking insurance again, there are different things that cause, things to go bad. Fire, earthquake, wind, hail. Those are perils. One of the scams in the insurance business is somebody comes around selling, say, a cancer policy or a specific, where a specific peril is identified in the policy. You don't want that. You want all perils. You don't care, what destroyed your house, what destroyed your car. You just want coverage. Now, unfortunately, say in a home situation, you may find that you think you have all perils insurance, but there might be an exclusion there's going to be exclusion for flood because that's a federal program. That's a separate program by definition. Also, the big one is earthquakes. Earthquakes are typically not covered. So, again, that gets back to the home buying process. You need to make sure that you do a good have a structural engineer or somebody inspect your home prior to purchase, and then you need to realize your limited amount of coverage. You might have FEMA, the emergency management people at the federal level, step in to help you to a certain point, but best thing to do is avoid it and, reduce it. Do what you can to mitigate that risk. Okay. Here she's buying shares in a company that pays a dividend. She's looking for an income fund, right? Not you're looking for companies that are, typically blue chip companies, meaning blue chip like as in big established companies, no longer so much interested in growth. They're retaining their shareholders by paying them a dividend, a regular income, and there you go. When you have a loss and negligence, harm property, we're talking about liability, right? If your actions cause harm to somebody else, that's liability. Now, it can be made worse, like we talked about just before, if you're found negligent. But in any case, let's say you're driving a car and there happens to be snow on the ground, ice on the ground, and you slide into them, and that's not quite an act of God. That you were actually driving, so you are liable here, and you weren't negligent, but you're still responsible. Renter's insurance, yep. If you have renter's insurance, it's usually quite affordable. You're not insuring the structure. You're not doing much. All you're doing is insuring your personal items. A landlord will often insist upon you having renter's insurance, though, because there's usually some sort of liability for your actions that you've got some sort of coverage that will be gone after before his or hers liability policy will be enforced. This lady's got a coffee maker that's known to be, defective, probably a recall. Fire would be the peril. Risk is kind of what she's taking, but the definition of her bad coffee maker, that's a hazard, right? So other insurance terms, premium, that's the amount of money you pay for the insurance company to assume that risk. Deductible, that's the amount of money you pay out of pocket before they start paying. So a bunch of different terms there. Perils, the fire, the wind, the whatever. Risk is what you're trying to insure against. Premium is the amount of money you're paying to get them to assume the risk. Deductible is the amount you would pay, but hazard is the danger thing. And if you allow it to exist, now you're getting into negligence, and you allowed it to exist, so you're also liable. So it kind of cascades. Here's a lady got a bunch of money to invest, going to spread it around a little bit. That's called diversification, right? Not putting all your eggs in one basket. So again, that's the primary reason most people get involved in mutual funds is to diversify. Beta, we've talked about betas of stocks. When you're trying to say if somebody says something is volatile, meaning the price changes a lot in comparison to what? Well, that what is the beta. The beta by definition, is they get the S&P 500, the Standard & Poor's 500, which is a stock index, a bunch of stocks that move around, and now you say a stock has a beta of 1.5. That means it's 1.5 times more volatile than the S&P 500. If a stock has a beta of 0.75, that means it's only 3/4 as volatile as the S&P 500. So if you say, what's the beta of the S&P? That's kind of a trick question. The beta of the S&P is 1 because that's the measuring stick. By definition, the S&P is 1. All right. Ease at which an investment can be bought, sold, turned into cash. Anything can be. That's liquidity, right? Bond with the highest rating. Obviously, it's just a grading scale. So what you're looking for is, capital A's and more of them. In this case, the multiple choice one with the 3 A's is the best choice. You get down into B's, you're down into junk. So it doesn't take long. A single B, and you're looking at a very dicey investment. A lot of insurance stuff on this one. Legal responsibility for financial loss of another. Liability, right? Now, there's certain things that I did kind of mention act of God here, and that can happen. Let's say, there's a friend of mine down in Florida, a lot of storms, hurricanes and stuff. Big old tree from his yard, from my buddy's yard, falls across, destroys the fence, crushes this guy's shed. You're liable for that. No, not necessarily. In this case, that's an act of God. If it's a good, healthy tree and it just gets blown over by the wind, there's the liability in this case is under the act of God category, and my friend's not responsible because he didn't. Anyway, I don't know why I'm picking on exceptions, but there can be exceptions to liability, but best way to do it is just avoid. If you've got any sort of action, any sort of responsibility when something happens, For example, I've got a lot of raw land, right? If it's just raw land and somebody, basically is trespassing and runs into a tree on my property and hurts himself, that's not on me. That's a natural thing. If I string a cable across the property, now even though they're trespassing, I created a hazard. I could have some problems. The best way to do it is maybe not improve the property unless you're going to be able to manage it. Okay, here's a person, another stock problem. Yeah, where they buy, a certain amount, they invest over a certain length of time. How much do they end up with? So again, just a word problem for math. Examples of what people would do with life insurance. Yeah, perhaps. Yeah, you can fund an endowment, charity, estate taxes. Anyway, it could be used for a number of things. Here's a lady. She's selling some stock, or has some stock, and the stock is starting to get quite valuable. So, again, like I was talking about the NVIDIA stock I had, the stock price was getting up above $1,000. And so what they did was they said, we're going to do a 10-for-1 stock split. And so they get that stock, and they say for every share you had of NVIDIA at $1,000, you now have 10 $100 shares. Did that generate any wealth for me? No, not necessarily. I mean, the stock's doing well, but the split itself didn't generate any wealth. But what it did do is it presented NVIDIA with a more manageable stock size. So you can have reverse splits too, where the stock price is going too low and they can do the opposite way. But anyway, not a good situation when that happens. When a stock splits 2-for-1, it would decrease to half its pre-split price. It's just a simple math problem. It's just to get a stock price more manageable for what you're looking for. bond. So if you've got a bond, and we said a B bond, is down in the junk category. If a bond actually has a rating of D, that's not even an investment anymore. D means default, means they're not paying, not one bit. We got a dog there going nuts. We're going to get through this, though. Well, let me see how many more we got. Might pause it. All righty. So we've got real estate. Great investment, very stable, long-term appreciation, but illiquidity is one disadvantage of any type of real estate investment. The fact that you can't turn it into cash quickly. Here's another one. All right, here's a question asked, what's the following as a true statement? And one of the answers is a corporation obtains equity capital from bondholders. No. Bondholders, that's a debt position. That's not an equity position. So that's out. Corporation must issue either preferred or common stock, but not both. Nope, they can issue both types of stock. Corporation experience financial problems. Investors should purchase common stock rather than preferred. No, that doesn't matter. There's slight advantage to either. I generally don't get involved in any sort of stocks or paying dividends, but anyway, you'd have to study the individual stock, but that's not a necessary thing. Most corporations will sell options to satisfy a large part of their financing needs. No, selling options is a different animal. A stock split may not cause a stock price to increase. A stock split, like I said, is just an independent operation. It just means you're changing the price. It doesn't affect the value of the stock. It's a 1-for-1 conversion or a 10-to-1 conversion or whatever, but it's just a mathematical. There's no revaluation taking place in it. It's just, if you have one share at $100 and it splits to two shares at $50, that's exactly what it is. So, kind of a confusing question there. Not something you should do when you're involved in an automobile accident. Well, just common sense. Obviously safety and making sure people are squared away is the most important thing. But discussing what happened, don't do that. There's no need for that. Plenty of time for that later. Anyway, this is primarily about mutual funds. Which of the following is true? 87 million people have mutual funds. True. More than that now. More than half of U.S. households have mutual funds. Again, true. Most people don't even realize it. Most people don't know that, I just have my 401k and I don't know what I actually have. You probably should know what you have, but you'll be pleasantly surprised to find out you do have mutual funds, which is probably not a bad thing. There's more than 12,000 mutual funds available, which is actually more than the number of corporations. And combined value is a lot, many, many trillions. So all those would be true. Greatest growth potential. So you got your choices are a bank account. No growth potential there. Corporate bonds, that's small. Income, government bonds, very secure but not known for growth. Treasury bills, just another government bond. But common stock should typically get you about 10%. Least liquid out of all these, and again, it's going to come back to real estate. Real estate is the least liquid investment typically. Choosing investment, risk factor. So during inflationary times, there's a risk that financial return on investment will not keep pace with the rate of inflation. That's very true. I'd say 70% of the investment products out there don't keep track. keep pace with inflation. Inflation is you're going to lose money. Which of the following applies to term insurance? Protection for a specified period of time, right? It is a term. Term insurance is great. You buy it, you don't pay that much for it. It only protects you for a certain term. It's very easy to match what you have in terms of what requirements you have. You say you need $1 million worth of insurance because you want to pay off the house. You want to put $250,000 away for cash. You want to have some money set aside for the children's education. You can make specific goals. You come up with a certain amount. You buy the insurance. When you can't get the insurance 10 years from now, doesn't matter because you're that much farther along in your mortgage. The kids may or may not be in school, and you reassess and you see what insurance you need at that point, if you need any at all. So, very easy. Following statements is false. There people will talk about absolutes. They say investors who purchase mutual funds are guaranteed a higher rate than if they were to purchase comparable stocks and bonds. No, you could end up that way by being diversified, maybe, but chances are if you pick the correct individual stock, the individual stock would have outperformed, but you could have picked the wrong stock and you could have got clobbered, or that company could have gone out of business. So the reason why you're doing mutual funds is to spread out the risk. It's not to necessarily try to exceed the rate of return from an individual stock purchase. Bonds are a form of debt capital. That is true. Stocks are not debt capital. Stocks must be repaid. No, stocks don't expire. Bonds have to be repaid at maturity. They do. And so anyway, the only correct answer is that bonds are a form of debt capital. Who has the greatest need for life insurance? Well, you're looking for the one with the greatest, responsibilities. So one of the answers here is somebody with small children. Yeah. Singles living alone don't need it. Living with your parents, you don't need it. Dual income couple, it's going to be emotionally traumatic, but the other person's making money, so they'll get by. Anyway, children, that's kind of a sick thing too. You'll see that where they're offering life insurance for children. Well, if my child passes away, the last thing I want is some sort of financial windfall, So the parents need the insurance, not the children. True or false, you can depend on Social Security to pay your basic living expenses. No, not depends what you define as basic. It's going to be fairly meager, and it's in worse shape now each day. The program's basically insolvent. So maybe there'll be some changes made, but even in its good day, it's a supplement, is what it's become. And to pay all your expenses, you have to be pretty squared away. If you already own your home, you've got some other medical insurance, maybe you can get by with it, but it's not going to be pleasant. The coverage on your automobile policy that protects basically all the everything, the cats and dogs kind of stuff, that's a comprehensive, right? Collision is the one that protects you if you're at fault. Some of these other ones, liability insurance, but no, comprehensive is the one for windshields and things like that. All righty. I know that was a lot. 72 questions. But I think we hit on the high points of everything. It's going to be a challenging time financially for you all in the personal finance realm. The overriding lesson out of this thing is basically compound interest. Take advantage of that when you can, but also live within your means so that you can accrue assets that can be influenced with the compound interest. So that's what you're after. Good luck. Hand in the term papers as you finish them. If you need more advice on that, let me know. But I think you've got enough knowledge now. The instructions are not vague, but I don't want to tie your hands. I want you to make the term paper as useful to you as possible. So good luck with that, and good luck with the rest of the course.